free. They explained all the terms, and there's some more terms. The ones I'm teaching you today are the basic terms. But the books are there, and you can get them from the brokers. And if you're unclear about the mechanics, don't bother me with that. Bother me with questions about the market. That's not a bother, because I enjoy answering those questions. But answering questions about the mechanics of the market, that is a bother for me. Ask your brokers those questions. Let me tell you about who the players are in the marketplace. This is who's in the pool swimming here. We have people known as technicians. We have people known as fundamentalists. You'll hear another term, which is speculators. And then you'll have commercials. You'll have floor traders. And you may also hear on-floor and off-floor. I'll briefly define these. Technicians are people that keep charts, probably, or computers anymore. Technicians use charts and computers because they're looking at primarily just price structure alone, thinking that we can divine the future of the pork belly market. If we sit here and study this chart long enough, we can say, oh, this is going to happen because some relationships in the price. That's what a technician does. A fundamentalist doesn't look much at the price, but a fundamentalist friend over here is going to look at how many hogs are in existence right now. What's the birth rate of the hogs? Is bacon a popular thing to eat right now? Or is it not popular? Is there a disease in the crops? What's the price of corn? Looking at the fundamental price supply-demand relationships. Speculators is just kind of what the word stands. That's people who are just stepping in the marketplace and trying to be buyers and sellers. Commercials. This is the big word right here. We're going to get into this in tape 2. These are the guys with the brains. They've got the money. These are the people that use the commodity, and I'm going to teach you how to follow them, how to know what they're doing. And we're going to follow and mimic what these guys do. Floor traders are people who are on the floor, and they're filling our orders for us down there, by and large. Floor traders usually have the desire to go off the floor and trade upstairs or off the floor, as we do with maybe a chart book or a quote machine. Some of them like to trade on the floor. Now, a guy trading on the floor has a totally different parameter than you off-floor traders. The guy on the floor is trying to get maybe 1 tick or 2 ticks in a market. In other words, it's just a minimum price fluctuation. You get 2 of those, he's happy, he's done. Whereas an off-the-floor trader needs a bigger move than that. The on-floor trader, since he isn't paying commissions, or he's paying maybe $1, something like that, because he owns a seat there, he doesn't need much of a move, and he's just going with the flow of the market. He doesn't know anything at all, and at the end of the day, he shouldn't have any position. He should be flat. He's just going with the swings of the market as he internalizes them in his own gut. An off-floor trader, though, is trying to catch a bigger move. But you'll hear those two terms used as well, on-floor and off-floor. The trading styles would be the technician is using charts or computers. The fundamentalist is using some math, probably, and looking at supply-demand relationships. And the other trading style is emotions. Just feels right. And sometimes that's not a bad one. In the early 70s, one of my students said, Larry, I had this dream last night. In my dream, these people were wheeling in big loads of silver dollars to the bank in Salt Lake City, Zion National Bank. He said, so I'm going to go out and buy silver dollars. And he did, and then silver took off. So it's a great system for him. He's been going to bed every night since, trying to get more dreams. And there is an emotional aspect to trading, and some people want to trade with their emotions, or their feel, they call it, and some people want to trade with systems. So you could be a feeling trader or a systematic trader. I think the best is kind of a combination of both. I think systems can be of great value, but I think they're limiting too, because the markets change as well. So you need to have a system and think. That's what I do. That's my basic approach. Well, let's talk about your trading style for a little bit. This is really important, because one thing I've noticed now in doing this video series is a lot of people try to be Larry Williams. You can't be me, and I can't be you. And there's this great popular concept out there, I'll model somebody who's good. I'll be just like them, and I'll be as successful as they are. And that's a very popular thing right now, to model. And I thought that made a lot of sense to me. But you know what? I read a real interesting study. They're going to do a modeling program of the great quarterbacks to see how they threw the football. So they really knew how to throw it. And you know what they found out? The one common thing about the great passers in the game of football? The one and only one thing they found out was that there was nothing in common amongst any of them. The only thing they could come up with. And I think that makes a lot of wisdom, that you can't fit yourself into somebody else's model or mode, because we are all different. My experiences are not your experiences. You certainly, heck, don't want to model me if you don't like risk, because I have no fear of risk. That's my biggest problem in the world. I'll walk into anything. I don't care. You know, I for some reason, don't have much fear. I wish I had it. I don't. So you don't want to model that part of Larry Williams at all. So you have to figure it out yourself. And I can tell you some things that might help you figure out your trading style. And I would say the first thing you need to decide is, how do you make your decisions? Does it take you a while to come up with an answer? Or are you just real quick like that? You know, like, I have some friends that say, boom, 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 boom. They got answers like that. That's not me. I'm kind of a plotter. In athletic events, I wasn't a sprinter. I was a quarter miler, and now I do marathons. I mean, that tells you how I think. How I can physically respond to something is I like to think about it a little bit. Whereas I know to be a real good day trader, I have to tell myself, I just got to be pop, 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 pop. I can't think. I just got to react and do it. Some people can't do that at all. If you're going to be a long-term trader, you can't be going boom, 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 boom every 3 or 4 minutes, can you? That won't work at all for a long-term trader. I know a guy who says he's a long-term trader, but he's rolling over his account about every 3 days. And I said, and this guy's a farmer. I said, if you planted your soybeans, would you go out and look at them 2 days later to see if they'd sprouted yet? He said, no, you'll kill them. So, well, same thing, if you're a long-term trader, you don't go out and dig them up, every 24 hours, or, well, in case of short-term traders, every 15 minutes or 5 minutes to see how they're doing. You can't do that. You just have to kind of let it sit there and let it come to fruition. Whereas that's the strategy a long-term trader needs, one of kind of sitting back and letting it be. A short-term trader really has to be on top of things. So it's how do you respond to things? You look at your athletics you've done, how you respond to things, how you deal with your children, how you deal with your business, and then you might have a sense of, oh yeah, I'm kind of moderate. Maybe my average trade should be 10, 15 days, or I like 60-day trades, or boy, I want to come in and boom, 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 boom. The other thing I've noticed, and this might help a little bit, I think the younger you are, the more you can short-term trade. You have more energy, you're more focused, you don't have kids and soccer and all these other things going on in your life. You can really put the blinders on and do it. I don't do a lot of short-term trading now. When I did, I wasn't a very nice person then either, I should point that out, because I didn't care about anything. I didn't care about anything but the markets. And I was really focused. I made a lot of money. And it was great to make a lot of money, but nobody knew who I was during that time period, and I didn't know who they were during that time period. All I cared about was the market. Especially here in California, I'd be up at 4 in the morning and probably go to bed at midnight, and all I was doing was the markets, man. I was the best in the markets that there was for a time period at least. And then I realized it was kind of, made a lot of money, but it was pretty empty too. There were a lot of things I wasn't getting out of life that I wanted to get, so you need to look at that side of the equation as well. And that kind of fits with your lifestyle. If you live in the East Coast, it's going to be a lot easier for you to trade the currencies. Here in California, they open at 5:20 in the morning. Now, there's not a lot of people that can roll out of bed every single morning at 4:30, 4:45. Or maybe you can, but your spouse doesn't want you to. So you have to, how does this fit your lifestyle? Where do you live? I have people that trade from Saudi Arabia, from Japan, from Australia, and they trade based on their time frame, when they can get up and when they go to bed and how it fits them. So you need to look at that as well. What's your lifestyle? Where does this fit into your lifestyle? You need to seriously address that question, because you can't trade outside of your lifestyle. I now know exactly what my lifestyle is, and I trade within that lifestyle, and I have a lot more fun living now than I ever did when I was trading without looking at my lifestyle. I'm very much a lifestyle entrepreneur. I want my lifestyle first, and then I'll make money to support the lifestyle, as opposed, I think it used to be, let's go make money and then we'll find the lifestyle. Well, I know my lifestyle, and then everything else is based around that. So you might want to look at what your lifestyle is, what your waking hours, your working hours. Most of you probably aren't trading commodities full-time right now. You've got a job. Is that right? Right. Some of you do, some of you don't. We have to work around that too. Because I know when I first started trading in Portland, Oregon, we didn't have quote machines back then. There was a clock. I was trading stock, and this bank had a clock, and it would throw the time, the temperature, and every 15 minutes the Dow. And my boss always kept finding me. I'd open up the window, I'd look out to see what the Dow was doing. That was my first quote machine. And, my boss kept seeing me do that. Obviously he was a little upset. I wasn't working. I was looking out that window to see what's happening, keeping my charts and stuff. So you have to find something that's compatible, that doesn't interfere with the rest of your life until you get to that point and say, hey, I got this thing knuckled down. I can do it. I can trade full time now. But develop it, phase this into your own lifestyle. Don't go out and try to alter your lifestyle. Make this work around you, and then you're going to be a lot more successful. You won't have all the pressures, for one thing. You won't be trying to look out the window and make certain that the boss doesn't see you. And I think that will help define what your trading style is. Well, let's talk a little bit about greed and fear, and then we're going to take a break and come back into trading the markets. The two compelling things that traders have going are fear and greed. Those are the big emotions that we always have, and I want to talk a lot about those because until you understand fear and greed, you're not going to be a good commodity trader. And my goal is to make you a good commodity trader, the best trader I can make you. And if you don't understand those two emotions, you're not going to maximize your potential. I want to first talk about fear. Fear keeps us from doing things. That's the purpose of fear. God gave us fear so we don't rush into the lion's den when the lion's inside there. In other words, we should be afraid of things. Fear blocks us from doing things. That's what you need to know about fear. It's a blocking mechanism. It blocked us because we have anxiety about an unknown event occurring. So we need to reduce our anxiety to get rid of this blockage. And you can reduce your anxiety in this business real simple by having stops. Saying every single time I have my trade, I'm going to put in how much money I want to risk, and that's it. That's all that's going to happen to me. I'm not going to lose much. I might get some slippage of where my fill is, might not be my exact price, but I've limited my risk because my stop is in the marketplace. So that's something you can define right. I know how much I'm willing to risk on a trade. I'll bet you people do too. And if anybody has a lot of fear, it's because you haven't assigned your risk and said, that's it, I'm not going to lose more than that. So to overcome fear, if fear is not getting you into trades, just say, this is my maximum stop loss, that's my stop, it's in the market, that's it. And you've now controlled the risk element, and you shouldn't be blocked or hindered from trading. Question, please.
Larry, the proponents of options traders mainly, of course, cite the fact that you can place stops, but of course in a fast-moving market, it could blow right through it, and you can lose everything you made that year. Now, being that you've been in the business 30 years, I've always wanted to ask, how reliable are the stops? I know you have some slippage, but in your whole history of trading, how many times really would you say you've got hurt that bad where you wish you might have had an option?
One time. The propane experience I talked about earlier, I wish I would have had an option then instead of, because I couldn't get stopped out of the market because it was locked limit. I've seen markets blow through my stop, sometimes in the S&Ps by pretty good slippage. In other words, I'm not filled at the exact price where I wanted to be filled. But for my case, I would rather play that game than have 90% of my trades expire worthless. So while people who are selling these options to us will espouse that argument, my actual trading experience is the other side of the coin is I'm going to be in some lock limit moves where I'm long, and it goes lock limit. And that's the best of the entire situation. So I would prefer to have the opportunity of getting lock limit moves in my favor as opposed to being in an option that may actually lose value the same day the market's up lock limit. I think that's the way I do it. Now, that doesn't fit for everybody, as I just mentioned earlier. You have to find your comfort levels. But like I've said, I've spent my life figuring out if they're going to go up or down. Somebody else can take that information and figure out how to use options on what Larry Williams knows. That's fine. I just don't have enough time to be good at both. And I want to be good at what I do. And so I put my attention on up or down in the markets as opposed to using options with them. But I can only think of one time where I wished, heck, I would have been in options. And the other times I lost money, I would have kept buying options anyway. I can think of a time when I lost about $3 million trading cattle. And I wish that I wasn't in that trade, but I know I believe in it so much I would have bought options all the way down too. It wouldn't have mattered. I would have bought them and they would have capped out worthless as well. So I hope that answers your question for you. Okay. So fear is the blocking mechanism, and what I found is, what most people are afraid of taking? The winning trades. Isn't that something? You're afraid of taking the winning trade. I know what you people are afraid of. Your fear is taking the winning. You love to take a losing trade. And it isn't that you want to take the losing trade, it's that the losing trades look safer. The winning trade's like, whoa, either it looks too easy, the market can't be that easy, so I'm not going to touch that. I'm going to get over here because you got this one all figured out, and that's the losing trade. So if you feel fearful about a trade, that's the one to take. If there's any emotional rule I can give you, and that you're all laughing, you know it. You know, how many have looked at winning trades and you're afraid of them? Could you raise your hand? Yeah. It's the winning ones that are hard to take. But if you know I'm going to place my stop, that's it, I have my absolute stop, now you're protected. Now you say, I can take that trade that scares the bejeebers out of me. I can take it now because I am going to use a stop, period. So by controlling your risk, you can get rid of your fear. Fear is you got to be really, you can't let fear block you in this business. Now let's talk about greed. Greed is the worst emotion. Greed is much stronger than fear. I know that because I've held on to my losing positions too long. How many people have held on to losing positions too long? All of us, right? Every single person here has, if you traded at all. Because you keep hoping. People say, Larry, what should I study to be a good commodity trader? And I finally figured it out. You should study religion. Because every trader I know at some point in their life says, oh, God, help me. Because they're too greedy. They keep holding on, holding, hoping it'll come back. They're going to go to church 3 or 4 times a day if need be. Whatever it takes. They're going to make donations to charities, anything to get those markets to go back to where they were. Because you're just too damn greedy. And by the same token, after the market's had a nice move, you're too greedy again. You want it to go higher. And you don't get out when you should get out because you think, one more up move and I'll be able to get whatever it is I want. You're too greedy. So we have to learn to control greed. And this is a more compelling emotion. It's a more difficult emotion to deal with. Fear, simply place your stop, that's what you're going to lose. You pre-assigned your risk. But greed, probably the best way to deal with greed one of the best ways is this. When you bring out your calculator and you say, I've got 6 contracts times $500 each that I've made, wow, I've made all this money, speed dial your broker. That's the high. When it's like those old movies where the bank robbers say, hey, Willie, one more bank and we're going to retire. That's the bank they get caught robbing, right? Same thing in trading commodities. You get that price that's up there and you think, oh, this is great. I call it the King Kong feeling. Remember King Kong movies, both 1 and 2? When did they shoot King Kong? When he's on top of the Empire State Building with Jessica Lange in his hands saying, I got her, this is it, Fay Ray. And then they kill him. That's the end of King Kong. He dies. But at that instant, he had the world. And you're going to have that feeling trading. You're going to feel, man, I finally know how to trade. No, you don't. You know how to trade, you don't know how to get out. So speed dial your broker. Get out. Don't wait for that last move in the market. Have pre-assigned values. I'm going to show you how we set targets and how we have things to get us out. But don't get too greedy. Because the problem with trading is that you're never right. And this is an important psychological thing to understand. In this business of trading, I am never right. And I am convinced the human mind works on wanting to be right. How many people would rather be right than wrong? All of us, right? Yeah. You're never right in this business of trading. Never. If you're a doctor, your patient gets better. You were right. If you're a lawyer, you win the case. You were right. If you're a mechanic, you fix the car. You were right. You're acknowledged. You're appreciated. You were correct. I've been trading for 30-some years, and I've never been right. I have never been right. And let me explain that to you. On my losing positions, I've always had too many contracts. Right? and it was a losing position. On my winning positions, I never had enough contracts. And I never got out at the right time. So it's a very frustrating business. You're never right, and our mind wants to be right. It wants to get out at the high tick. You can't do that. Only guys that write books and sell newsletters can really do that in their newsletters after it's the fact. Nobody gets in at the exact highs and lows. I don't care. If they tell you that, forget it. That doesn't happen. It's a tough business. You want to just take chunks out of the marketplace, and you have to realize that you can't be right, but you can make a lot of money. There's a difference between right and making money. If the goal is to make money, great, you can do that. But if the goal is to be right, you're never going to be right in this business. So by having established targets and points where you're going to take your profits, you're going to say, hey, I'm not going to be that greedy. I'm going to learn from Larry, greed kills. And then you'll know where to get out of your trades, and I'll show you how to get out of the trades and just walk by. I've got a lot of trades where I get out and the market moves higher, and I kind of feel like I'm glad that's happening. Somebody else is making some money there. That's my belief system. Somebody else is doing it, that's fine. I got out what I got out. I'm a happy camper. But if my belief system is, damn it, I didn't get out at the right point. Oh, I'm upset. What does that do to me? It gets me frustrated, it gets me angry. It gets me trying to get into the market again, doing everything wrong. So my greed syndrome is, I can't be right in this business. I'm just going to suffer whatever I suffer, and I'm going to take the profits as the profits come along and be happy with those profits. Well, I hope by now you've got a basic understanding of the commodity markets, a little bit about how they work and how we work, who the players are, and what the data is that we're going to use to trade with. Because as you turn on the next section, we're going to see how we actually figure out who these commercial people I alluded to are, how we can track them, how they show us when the markets are going to go higher and lower, lots of things. So rewind this one and come back to tape 2, and we'll get into actually how to tell when the market's going to go higher or lower. For those of you that didn't watch the first tape, there are a couple things on there that I think are important that I want to go over. But the most important thing, and you really should watch the first tape, the most important thing is controlling your potential losses by using stop losses. Now, this is an argument that's gone around for a long time. People are essentially afraid. It's really strange. People are afraid to limit their loss. They're afraid to use stop loss orders. They're afraid to place a stop in the market because you people are so paranoia that you think somebody's going to go run for your stop. Somebody on the floor is going to go get your stop. Is that right? Have any of you ever felt that? Let me tell you, you people are paranoid. They are not going for your stops. I want you to get rid of that idea. They're not interested in your stops. They're coming to get mine. And I still use stops. When I traded large, I'd trade a couple thousand bonds at a time. That means each tick is worth $64,000. So the market gaps up 10 ticks. You're not out of bed yet. It's $640,000. It focuses your attention. I consistently recall having the market go within 1 tick of my stop numerous times. I know in my commodity timing newsletter with my daily hotline that it's not unusual to see the market go to within 1 or 2 ticks of our stop and then turn right around. We had it happen in cotton this week. Our stop was 40 and went to 30. So it's not an unusual occurrence. If you're getting stopped out a lot, it isn't that they're going to get you, it's that your stops are in the wrong place. You don't know where to put your stops, and I'm going to show you where to put stops. So that's more important. You've got to use stops. Even if they are going out to get you, you still have to have them to control your risk. This is largely a game of risk control. The difference, I've interviewed winning traders and losing traders, and the biggest difference is the winning traders have risk control and the losing traders are religious. They're praying that they're going to get bailed out of this one. You've got to have risk control. And the other thing is I noticed about the winning traders, it's like athletics, like football. Those guys who are going to play football Sunday know they're going to get injured, don't they? They know they're going to get hurt, but they still go out and play. They know that that's the nature of the game. And that's the nature of trading commodities. You're going to have losses. You just have to try to control those losses. And I'd like to make a final point on the paranoia thing. When I was at Buster Douglas, Evander Holyfield fight in Los Angeles a couple of years ago now. I was with a guy who was at that time was the largest bond trader in the history of the world. And he traded in the pit, Charlie DeFrancesco. And we're waiting during the preliminary fights. We're trading on cellular phones. We're trading bonds. It shows you our reality. And I'm buying and he's selling. And he says, "Oh, it's you off the 4 traders. You're going for my stops." I say, "No, it's you're going for our stops." It's not unusual for people on the floor to call me and say, "What's going on down here?" Because it's such pandemonium down there. But maybe I can drive all this home the best because people are looking for these people that know everything. Several years ago, I was in New York City. My secretary reached me and she said, "Larry, there's a banker from Switzerland who's trying to reach you. I'd like you to call him." And I go, "Oh, this is great because I want to find out what gold's doing." This when gold was hot. I'm going to call this guy and see what the gnomes of Zurich have to say about gold. This guy was at the second largest bank in Switzerland, head of their investment. So I called him up, and the conversation kind of went like this. "Well, how are you doing, Mr. Williams?" Fine. I said, you know, he said, "Well, Mr. Williams, if we would like to hire you to tell us where the price of gold will go." You're going to hire me? I was going to ask him. They didn't know. In Zurich, they're willing to find somebody like me. So I don't know that there's anybody that really, truly knows the be-all, end-all of the markets. It's just like football. You're going to get injured in this game. You just hope that you'll win a few along the way. There's always injuries out there, and you just need to control those injuries. We do that by using stops. Use them, absolutely. They've got to be there. If you don't trade with stops, you shouldn't be trading, period. If you're getting stopped out too much, your stop's just in the wrong place. It isn't that they're going out after you. It's just the truth about stops is really this. Most people place their stops too close to the market because they don't want to lose anything. And their stops are too close. I saw an advisory service advertising says, "We'll show you how to trade with $150 stops." Well, I'll show you how to trade with a $10 stop. You're just going to get stopped out a lot. The closer your stops are to the markets have a lot of irrational, random activity, the more you're going to be stopped out. So my stops, they're quite a ways away. I love to feel that pain and agony of being stopped out because I know it's real. If they really come to my stops, that's a real move. It's not just some little gyration because somebody sneezed in Russia. There's a major change in trend has undergone. So my stops tend to be further away, and I don't get stopped out as much. When I get stopped out, my loss may be a little bit larger, but I'm willing to say, hey, I'm only going to risk $1,500 in my S&P trades. Maybe it's too big of a risk for some people, but that risk is the best to use in the S&Ps at this time. So I want a little larger stop. I don't get stopped out as much, and if I do get random activity, maybe it'll even get me out of my target and I can make a profit. So you got to use stops, and if they're too close to the market, you're going to get stopped out a lot. Okay, now let's talk about how we can predict where the market's going to go, and this is really the essence of what this course is about. The essence of what my 30-some years trading the markets are about is what I'm about to talk to you about. Remember, in the first tape, I talked about the commercials. Fortunately, the government reports to us the activity of participants in the market. Every other week, the government tells us what the commercials are doing. They tell us what the large speculators are doing and what the small speculators are doing, we the people. So we have this report every 2 weeks that shows the small specs, we'll call those for right now the public, the large speculators, large speculative positions, and the commercial. Now, I don't look at all at small speculators, and I don't look at the large speculators. I only look at the commercials. The commercials are the guys that really know the business. Their trading record is far superior to anybody else's in the game. Really, the way I've made money in the market on position trades is to follow the leader. It's a simple childhood game, and these guys are the leader. The commercials are the leader. And what I'm going to do is follow the leader. I follow these people. I watch them. I study them. I watch what they do, and they set up the markets for major moves. Now, some people don't like the fact that we get this information from the commercials. It's late. It's a couple weeks late by the time we get it. I don't care, because there's a huge difference between the commercials and you people and myself. The commercials accumulate over a time period and distribute over a time period. What we're trying to do is call the highs and lows of the day, or of a 5-minute bar. We want to get in and out, and we want to be exact, and they can't accumulate enough wheat to make shredded wheat and Cheerios and Betty Crocker's cake mixes in one day. can they? No, they have to accumulate over a long time period. So they tend to be early. They get in early, they get out early. They even get bearish too early sometimes, or they might get bullish too early sometimes. But that's not the point. The point is they show us when a market is getting set up for a trade. Now, they're not an absolute timing mechanism. This is what I want to make real clear. The commercials are not a timing mechanism. They are a setup mechanism. They say, this market's now getting set up. That's what's significant. We say, this market's probably now going to have a rally. Then we could bring in some other tools that say, and now's the time. But they establish what the future direction should be, and remember, they're early most of the time. So with that in mind, I'd like to show you some examples of commercial activity so you can see what their activity looks like, and you can judge for yourself if the commercials are as astute as I happen to think they are. Let me show you how I get the commercial data. You can get it on the World Wide Web under gov.cftc. I think that's, I'm not a real internet freaky guy, but you can get it on there. I think it's under gov.cftc, and it's a whole bunch of compilation of numbers. What I do is a little bit easier. I pay somebody, I think it's $75 a year, and they fax me every time it comes out the commercial position. And they've done all the math, and it's just so much easier. I get it every Friday. This one I just came through yesterday. This is being taped on a Saturday, and this is Friday's Commitment of Trader report. This is updated through 10/22. And you can see it's broken down into small speculators, large speculators, and the commercials. And remember, I only look at the commercials. The other guys don't mean anything to me at all. That's all I'm interested in. Now, given that, let's just take a market and we'll look and see. Let's take a look at Treasury bonds right here. I see that the net position, and this is what the next thing I look at, is the commercials are net short 19,460 contracts in the Treasury bond market. They've been selling there. Yeah, let's find one where they're long. Down here in the S&Ps, I guess that's no surprise to see that the commercials have been long the S&Ps, is it? The S&Ps have been going a lot higher. We'll try to find gold. Look at this. Gold, they're net long 26,678 contracts. The commercials are net long the gold market at this time. So I monitor this and watch how these commercials are doing. I come down to sugar. Sugar, this is the last week of October 1996. The commercials are net long 19,375 contracts. So I'm able to monitor their net position. Are they net long or are they net short, and to what extent? If I look at wheat, I see they're short 3,000 contracts. Soybeans are short a bunch, 73,000 contracts. Japanese yen, they're long 47,000 contracts. Canadian dollar, I want to sell this one short. They're short 52,000 contracts. So on my report, and this comes out every 2 weeks, I then can see what their position is, whether they're net long or net short. Now that's not just enough, because we have to put this in some perspective. And I'll show you the perspective we're going to put this in to see what we do with it. But at least you can see how it comes out. And the chart books that came with the course, you can call them and they can fax this to you. Or the futures charts out of Florida will also fax it to you. And then you've got the numbers. You can look at them every week. You can also get them. In fact, this is a good time to do this, to how to give you some sources. I download my data every day from somebody called Genesis Data when I do download. And I put this into my computer. And Genesis number is 1-800-808-3282. I download into software called Supercharts. And this is Omega. And these guys advertise so much, I don't even remember their 800 number, but if you'll see their ads in Investors Daily all over the place, all the magazines. This is the best software. You can download the Commitment of Trader data also from Genesis Data into your software. Also Future Source, and there's information on your videotape that came with this. You can get daily data, and I think they may now have access to it, and they do in their chart book. They have the Commitment of Traders reports in their chart book. So there's data reference sources for you. If you need to contact me for anything, the best way to reach me is 756-0421. My fax is 619, of course, 259-1331. And if you want to reach me on the internet, it is, or Larry, email, LarryWMS at ctiming.com. I'll leave that on for a little bit. This is the fax number. If you're going to call me, please don't call when the markets are opening, when the bonds open or when the S&P's open. That's not a good time to call me, because that's when I'm doing my thing of trading. Probably the best time to call me is any time from 1:45 California time, 12:45 California time, until maybe 3 or 4 in the afternoon. The next best time would be probably from 10 to 11. Sometimes in the morning I'm in and out or not there, and sometimes I'm not there. So if I'm not there, you're not going to get me. There's something I'd like you to keep in mind. There's only one of me, and there's a bunch of you out there. So when you do call, if you could just have your questions, because I tend to be a little rude on the phone. People will call up and they say, "Hi, you're such a great guy." I don't want to hear that. I want to hear a question. And they'll just say, "Well, I want to ask a question," and it goes on and on. I said, "What's your question?" "Well, I was wondering about," give me a question. So just have your questions ready. It's not unusual for me to have 100 phone calls in a day and 75, 60, 75, 80 faxes in a day. And I can't handle all that. So try to be as short and as brief as you can. And if I'm brief with you, please don't take it personally. It's just what I have to do. And unlike other people with video courses, I don't have any little postgraduate students that are going to answer your questions. You get me or you get nothing. And I like it better that way, because that way I'm responsible for the answers. If you've got a question about my material, I'm the one who's going to answer it for you. There are a couple of brokerage firms that can answer most of your questions about brokerage, and at LFG they've also had all their brokers watch the videotapes, and they talk with me daily. So if you've got questions, you might want to ask LFG first. And they may be able to answer a lot of questions that are just perfunctory questions, and go right ahead and do it. You don't even have to have an account there. They'll answer the questions for you. But if they can't answer the questions, then come to me, and I'll do my best to answer the questions. I will get back to you, and if I'm there, I pick up the phone. Nothing I hate worse than you call. You know the guy's in his office, right? And you call, and well, he's in a meeting. And that's a great popular excuse. If I'm there, I'm not in the meeting, or if I'm on a line, then you'll have to hold. But those are the best ways to reach me. We've just got the email stuff going, so if you want to reach on email, you can do that as well, and we can reply to you in that fashion. Okay. Let me show you what the commercials look like on a graphic or chart form. I've just picked markets at random. In fact, I think what I did was go through the chart book and get every single market, and we can look at all of them. You can take a look at what takes place here. This happens to be feeder cattle. It's kind of an inactive market. Not much happens. Remember how I said the commercials are long or the commercials are short? This zero line right here represents that they would be neither long nor short. When it's above, they're net long. When it's below zero, they're net short. I marked off the area here where they were net long. Look what happens when they were net long. Look where we are. Market rallied. Look where we were. Market rallied for 5 months. Market got long again. Look where we were. Pretty interesting, huh? Now look, at this point, they were very short. This little level right here. In fact, that's shorter than they'd been for a long time. And look what the market did. The market was right there. And the market came down. What do you think? Should we follow the commercials? And this is like in a nothing market, feeder cattle. I don't know who trades feeder cattle anymore. This is not like a big deal. This isn't like S&Ps and bonds. Well, I'm going to show you a lot of examples because I want you to see how consistent this is. And I'm going to give you some rules that we can do this by. Here's live cattle. It was just the next one in the chart book. And again, I've marked off when the commercials are long. Look what happens. We're there. We're here. We're here. And we're here, where they get net long. Gee, that's pretty good. When they are aggressively short, notice Here they were real short down in here, shorter than they've been for a long time. Look where that market was, right here. Now recently they've gotten very short up in here, and look where we are. We had another heavily short time period in here, there, and again there. They were not aggressively short up there. They tend to be at the significant turns in the right position. Here's cotton, tough market to trade. Cotton's a hard market to trade. Look where they're aggressively, where they've accumulated their position in the marketplace. These are the only times since 1993 when the commercials have been heavily net long. And as you can see, each time that they've been heavily net long, we have had some decent rallies in the market. The smallest one, from 80 to 88 cents, that's 8 cents times $500. What is that? $4,000 profit. Cotton got to the 66 cent area, rallied up to about 76 cent area. So those have been the small moves, and you've had some gargantuan move from 72 to over 96. Now remember, 1 cent from 72 to 73 is $500 in cotton market. Here we went from the 66 cent area to over $1.12. And here we went from the 56 cent area up to the 86 cent area, 30 cents times $500 a contract, $15,000 profit. So there's been some huge moves in this market, as you can see all the markets, that come about when the commercials are heavily long. I'm going to show you some more examples, and then I'd like to give you some specific rules that you can live by and trade by in these markets. Here's wheat. This is really interesting because in 1996, we had certainly one of the largest up moves in the wheat market that we've ever seen. But look what happened. The commercials went long. They got heavily long back here in January 1995, and look where the price of wheat was. And then we had a huge move all the way up to $7.40 a bushel. Remember, each cent is worth 50 cents. Each cent is worth $50 in the wheat market. So 360 to, let's call it 760. Take that number of cents times $50, and that's the profit in the trade. They were also, again, bullish in this area, right here and right here, and wheat moved up again a substantial amount. So the commercials getting net long is significant. Notice, though, that they actually started to get net long up here. Remember what I told you, the commercials tend to be early? Absolutely. So the fact we get this information late, fine. I'm glad we got it late. Otherwise, I'd probably be getting the market too early. Let's look at another market. Now I'll show you a couple that work. This is soybean. Soybean oil, different market. Again, I just marked off when the commercials are net long. And I'll let you judge if that information could have been of value to you to trade by. Absolutely. The major moves we occurred in this marketplace. I don't know what we were over here. It's blocked off from being able to see it. The major moves, that's where we were. Now, the sell side is a little different. What I look at in the sell side, I like to see them heavily short. I'd like to see that they're, remember now, this is our positive line and this is our negative line. This is zero right there. I would like to see the commercials at the most amount of short selling for the last 12 months. So we're way down over here. Notice this reading there, minus 400 or 40,000, 4,000. This is the lowest reading we've seen for all this time period, isn't it? Gee, that should be a pretty good sell signal in there someplace. Right about in here, we start to get our early warning selling indication that the commercials are now not only short, but heavily short this market. And right in here, they actually turn up. Look where we are, right there. The last time we saw the commercials that heavily short, right there. And then prior to that, we saw them short right here. Gee, sell there, buy there, buy there, buy there, sell there. Not bad. Let's see what they were doing. They didn't get heavily short at that high. Okay, let's look at some more. Again, these are just right out of the chart book, page by page in alphabetical order. There isn't any magic to this. I didn't just bring the only charts that's work. We'll go through page after page after page to drive home the point to you how powerful these commercials are. Most people say, oh yeah, the commercials matter, and walk away from it. Don't do that. Look at these commercial figures like your life depends on it, because it does. This is the fundamental cause of major market moves. These guys know more than I know. They know more than you know. These are the people that we need to follow. Look what happened in soybeans. They started accumulating in soybeans in here. They completed their accumulation phase. It took them a long time to accumulate. Now, this is a lesson you need to look at. The longer that they've been accumulating on the buy side of the market, the bigger the move you're probably going to have to the upside. Notice that they accumulated the heck out of soybeans, and then soybeans went from basically $5.50 a bushel to $8.20 a bushel. Again, 1 cent in soybeans is worth $50. You figure out how much profit's involved there, a huge amount. Finally, they start to get negative down here. We've got a 12-month low in short selling, and we get the first serious pullback in that market. Recently, now in October 1996, what's taken place is the commercials are not positive yet, but they're getting close to a 12-month high. This is the next lesson I want you to look at. Notice we are negative. This is our positive, this is our positive, this is our negative. We are still negative. In other words, as you heard the figures earlier when I read them, the commercials are still net short. But, listen to this now, they're net short, but their reading is at the highest or smallest amount of shorting for over a year. So I will look at that alone as a bullish indication. It doesn't absolutely have to be positive, but clearly these guys have stopped their selling and they've moved over to the buy side. So this is an alert to me that soybeans, some point over the next month or so, are probably going to establish a low. I've got a 12-month high in buying or a 12-month low in selling as one of my setup rules. If you have questions on that, make sure you ask me. Notice here they started buying early, right? But look where our 12-month high came. Where the highest high of the last 12 months came right there. Bingo, right at the low. So I'm big on a 12-month high or a 12-month low in the commercial activity. Here's gold. Remember how we said in soybeans, the more they accumulate, the bigger the move can be. Or this is corn, I'm sorry. The more they accumulate, the bigger the move can be. And they finally then get very short over here. There's our first selling indication. And we have to be pretty leery about the market from here on because the commercials have now been short, heavily short, for some time period, this entire time period. And the market tops. And I will show you how to fine-tune the timing. Notice again, they're very early. We'll fine-tune the timing. Now they've started accumulating corn in here, and they've moved now, as of this week, to the highest high of more than a year. So the corn market, as we talk in the last week of October 1996, is getting itself set up for a rally. The commercials are A, net long, right? And at the highest reading for 12 months. The commercials have been accumulating during this entire time period, have been accumulating corn. More interesting now, this is where you start to, it's tough to make mechanical rules. You've got to use some judgment. It's okay to think about things in life. What's happened to the price of corn? Corn's come down. Did that scare the commercials? They kept buying it. They bought all the way down. In other words, they're telling us they want this corn. They didn't back away from a declining market. In fact, they actually bought more. That's very bullish. Again, it doesn't say corn's going to bottom today or tomorrow. We still need to bring in some technical timing tools that say, okay, now we can get aboard this freight train, hopefully, and maybe we'll get stopped out and get back aboard the freight train. But it's getting set up now. This market is getting set up for an up move. Gold. This has been a real powerful market for the commercials. Notice when the commercials are long, where they got long here, 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 here. They stayed long for some time period here, didn't they? Biggest move we saw in gold. They got long here, nice rally in gold, and now they're not only long, but they're also at a 12-month high. Look at that right here. And what's gold done? Gold rallied. Like, it doesn't take any great rocket scientist or insights into the future. All you have to do is follow these people. These people need to be followed. If we look at when the commercials are heavily short, here's a 12-month, and there's a 12-month. So there's a sell, there's a sell, and there's a sell. You didn't think it could be that easy, did you? Yeah? We're all into the minutia of all this stuff. We're worried, you know, the Howard Ruff crowd is worried that the world's going to come to an end, and they want to buy gold, and the Keynesians say, oh, gold is a you know, worthless metal. It's garbage. Nobody should worry about it. All those arguments, you can argue all those arguments. I spoke at one of those gloom and doom seminars. I said, I got great news for you. The crash is coming. Boy, these people applauded. They were so excited. I said, in 2012. They booed. They want the crash now. Those people, given the choice of two disasters, want them both. And as opposed to getting into all those arguments about the end of the world, Bob Dole versus Bubba 2, which is what we're going to have here in November, it's irrelevant. What I'm going to watch is what the commercials are doing, because these guys need the product. These guys need gold. They need wheat or soybeans or whatever it is, and they know a lot more than I know. I can argue better, you know, than maybe somebody else can. In my newsletter, I make a great argument for it to go higher or lower. Totally irrelevant. These guys are going to make it go higher or lower. All these guys who write newsletters that pontificate on CNBC and all that stuff, we don't know very much. And we have no control over the markets. We have no influence on the market. Well, maybe our subscribers influence. If we all say go out and buy something, we influence for 15 minutes. But we can't accumulate for a long time period. And notice when they started their accumulation, look what happened here. They bought on the way down. Did it scare them that it was going down? No. Did it scare them they're going down here? No. They kept buying. And look what happened when gold started to rally. They sold the heck out of the rally. This big rally in here, they sold it. Bother them? No. They started selling actually in here. Well, they covered their shorts over here and here, though. They made a real killing on it, didn't they? And they probably got some shorts off up here, but they started their campaign here. So they're short in this area, and they're covering in this area. They did real well. And that's why I follow the commercials. When I grew up in Montana, my dad would take me deer hunting, and he'd say, you know, Larry, there's 3 deer up here. There's a fawn, there's a doe, and a buck. He said, and the buck, which is what we're hunting for, is probably maybe, it's an older deer, probably maybe a 5-point buck. So we've got to be real careful. See, how do you know all that, Dad? He said, well, looking at the tracks. He said, come here, son, let me show you. He said, now you can tell that's a big buck because a buck has what's called little extra hoofs back here, called dew hoofs or dew claws, and you'll see those in the snow. And that's a heavy animal pushing down. So you say that's obviously a bigger animal, and the spread is a little bit bigger on a buck than it is on a doe. So you can see what's there. He taught me to learn the tracks in the snow of the animals. And this is what I've learned, and my dad wasn't much of a financial type guy, but I always learned, you know, I learned things from my dad. Like, this is one thing, tracking deer. Well, these are the deer I'm tracking now. Just different deer, and you don't need snow. That's the nice thing about it. You live in San Diego. I like that real well. So these are the deer that we're tracking, and you can just go, and I'll stop this at some point, but again, we've got a platinum here. Notice the commercials never have gotten positive in platinum. They've never been net long. If they do go net long, that would be very bullish based on the past activity. So that's another way I look at the commercials, is let's look at platinum relative to platinum. How do the commercials act in a market? That's really important, because the commercials are a little different than, say, pork bellies and platinum or gold or whatever. So I will pay attention to platinum. If they get net long, boy, that's an unusual occurrence in platinum. I can still trade this by saying, well, gee, there's a 12-month high, even though they're net short, right? There's a 12-month high. And then I get to a pretty low reading up there, and we get another 12-month high here, and we get the same thing happening here. And then we get a 12-month low down here, and look where we are. Now we're close to a 12-month high in platinum. So even though it's negative, and see, that's a big thing. People feel, oh, well, the commercials are, a lot of people say, you can't do anything with the commercials at all. And they'll point to something like this. They've been short that market and the market rallied. Well, it's where the commercials are relative to what they've done in that market in the past. That takes thinking. It isn't just programming. Most people that have looked at commercials have said they're looking at, are they net long or net short? Meaningless. Absolutely meaningless. Are they net long or net short? Means that people call me up and say, what did the commercials do this week, Larry? Did they go positive? It doesn't mean anything if they went positive. It actually may be negative if they went positive, at least on a short-term basis. Have they been accumulating? Have they been distributing? That's the question you need to ask. Let me show you. Let me try to drive that point home a little bit more here and see if we can get an example of this. That's silver. Silver, net long, net long, net long, net long. Look where they got net long. Net long, net long, and net long in here. Again, showing what happens when this is their highest level of selling right there for well over a year, right? Right at the high in the market. So I want you to look at those relationships, not are we above the line or are we below the line. Life's not that simple. You've got to do some thinking and figuring out. Recently we've gone net long just a little bit here. And notice at this point we were net long and they switched to the sell side. Now since you're an educated group now, you know that just switching an on switch, off switch doesn't mean anything. Look what happened. It actually started to rally. As they switched to the net short side, it rallied over this time period. It wasn't until we got to an extreme reading, more selling than the last 12 months, that we got to the top. The mere fact that you've rolled over actually may be an indication that now the market's going to really move as it goes into a negative mode, because we know they accumulate. The fact that it goes from positive to negative, that's not what's telling us that the deal is on. It's what have they done over a time period. Somebody asked me about the Eurodollars earlier. What do I think the Eurodollars are going to do? And on one of the breaks, I said, well, gosh, look what's happened. The commercials have been long the Eurodollar. They were short in here. This was a 12-month. And look what happened to the Eurodollars. They came down now. The commercials have moved to the long side of the market more than they've been in 12 months. So someplace in here, the Eurodollars are probably going to have an up move. And the fact that in here they moved to the long side, they just switched to the long side up in here, doesn't tell us it's time to buy yet. They actually went from being negative to positive right here. It just says, okay, the deal is underway. That's all that it is. But I want to be real clear that just going positive to negative or vice versa doesn't have a lot of significance to it, because they now are starting the other side of that phase of accumulation or distribution. Treasury bonds, another market. The low of the year is seen down here. Look at the highest reading we've seen in Treasury bonds for, gosh, this was like 5 or 6 years occurred right there. And we have a high in Treasury bonds this year, and what do we see down there? The most short selling we've seen in Treasury bonds again for 3 or 4 years, right there at the high. So I want you to pay great attention and detail to what the commercials are doing. Recently, the commercials got very bullish in here, higher than they've been for 12 months.